Hi, everybody, and welcome to this week's Middle Class Investor. This is Seth Martin, and we had a down week this week in the S&P 500, although only slightly down, and could have been worse, but later in the week the market rallied and finished only narrowly down. The range, though, was pretty big. It was bigger than last week's range, although the range in general, as we've been discussing, continues to tighten in this rising wedge pattern. So we've been looking for the market to come up into this area, at least into this resistance box and potentially this upper trend line. And then we're looking for a break below the lower trend line on this rising wedge. So, it just basically the distance between this upper trend line and this lower trend line continues to narrow, and that creates less and less opportunity in the market for traders, which will eventually resolve itself either in a breakout above this area here or down below this area to here. So we don't really know which one will happen, but what we do know is that these rising wedges, when they break out of the lower line, they typically go back to the beginning of the pattern. And the beginning of that pattern is somewhere back here from the first part of October 13th, and that would portend an S&P 500 market below 1825. So that's what we're anticipating will happen. Now it could break out above this trend line and continue to go. Essentially, we're not going to do anything until it breaks below this trend line and actually closes below this trend line. So, but just know that once it breaks below this trend line, it could be a pretty significant move, and it could be pretty rapid. All right, let's look at the volatility. Volatility spiked higher, just like the market spiked lower, but then sold off, and looks like it wants to make even a lower low than this one, potentially lower than this one back here. Maybe down into this 11 area, which is pretty amazing, actually. That just tells you that what that tells you is that the market is very bullish. The participants in the market are very bullish, and yet a lot of the information, a lot of the economic data and other things are not really all that positive. So, not sure where all the bullishness is coming from. Could just be, the typical mania type stuff that happens at market turns. We saw this at 2007. We saw it in 2000. It doesn't look the same every time, but it has similar traits as those times before. So let's look at Germany and Japan and the United Kingdom. Here's Germany. We talked about basically as long as Germany stays above this trend line, it's likely to go up here to the resistance level before pulling back. So we've talked about this before. That now the other thing I want to mention now that I'm looking at it here is this is very overlapping looking. So when you get a lot of overlap like this, see how there's almost no overlap on this trend down. There's just the only part that overlaps is this little bit of area right here in the whole trend. But if you look at this one over here, look at how much overlaps. All this price action overlaps from the previous move up. So you had this move up, you need a pretty deep pullback, and then this other move up, and all this part overlaps. When you see this much overlap, it usually, I'm going to stress usually is more corrective in nature. So, for example, it could be, even though Germany is above this trend line, this could have been a leg down in the primary trend, and then this could have been a correction to that leg. We don't really know. All we know is here's the old high, and the market's moving up. Now, if the market, so now we've got a high, and we got a low here. But if the market comes down and starts making lower lows, so low here, and then let's say it makes a lower high, and then it makes a lower low, well then this probably is the primary direction of the trend, and this is corrective in nature. But you just have to wait. There's no way to really know this up front. You just have to wait and look at it and see. Let's look at the UK. The UK looks more broken, mainly because it's already broken its trend line. And you can see here we had a red candle for this past week after touching this resistance area. So this resistance area has been on the chart for a while. We've been talking about it. In fact, we were talking about it all the way back to here. Excuse me. We were looking for this move here to move up into this blue box. We got a pullback, and then I talked about the blue box was probably still in play, especially after this candle here. So we touched the blue box. I haven't moved the blue box since we put it on. This is just kind of the way the market works. We touched the blue box. It could pull back a little bit and then continue higher to some higher level, or it could start rolling over and going down here. If you were a trader, you would go short the UK below this level here, and then your stop would be above this level here. In other words, if you're a trader and you're looking for a short position, you would look for something that looks like this, where you have a close below here, and then ideally you would get some more candles that look like this, maybe like that. Who knows? Anyway, that's what I see there on the UK. As far as let's look at Japan. Japan hadn't quite reached its level of resistance, and it still may go higher. It looks like the stochastic's trying to roll over here a little bit, so it may not make it, but certainly you would expect at this point for this market to continue up into this area here before pulling back. So we'll continue to watch for that. Certainly there appears to be more stress in the market right now, probably because of something we've been talking about for a long time, and we're going to look at it now, and that is the 10-year interest rate. I'm going to zoom in and grab this low over here. What we were talking about is how this might be the low, and this would be the first move off the low, and this would be corrective. And we had this 1.8 area here, and we really never touched it. Remember, I talked about the midpoint of a large candle sometimes will be support. And you can see we pulled right down into just above it, kind of chopped around, and then it broke out. and what's interesting here is it was chopping a lot here, and this is a pretty decisive breakout. Now you would still want to see some a close above this area, but I've been talking to you for a while now about the potential dangers in the bond market, and just let's talk about some ifs. If this is the pullback to right here, then this would be this first move off the next move up, and of course the third move is the big one. So we would expect the interest rates to go up pretty rapidly in this next section if this is this pattern. Okay. Now we don't know if that's the pattern or not. We don't know. So we can't really say for sure, but that's how those occur. So I'm going to go back to the S&P 500 for just a moment, and we're going to look at a shorter term. We're going to look at a daily chart, and we're going to look at this in a minute too, because I'm going to show you on the SPY. These are places where entered trades for the YouTube video here. And you can see here now what I did, just so while we're looking at it. Remember, these are dailies. So remember, I sold out kind of early, right up in this area last week. Yeah, I did it again. Okay, there. And then what I did is I bought back right here in this area right here. And then, it started to move in our direction. But then we had this big down day, and the position went pretty negative. So I held on to it. But just to let everybody know, if we get a close, if the market moves below this area right here, then we will close that position. But right now we're still in it. The other thing I wanted to show you is, and we'll come back to that on the SPY. But the other thing we want to show you was the GLD, gold. I didn't realize this last week, but on this pullback right in here, this day right here was Friday last week. So Friday, Thursday, Wednesday, Tuesday, Monday, and this is the previous Friday. And we got our trade. I had a trade just kind of sitting out there, and it actually triggered right here to put us into gold. And so we were making money here on the way up, and then we had a fairly big down day here, and then a super big down day here, and another one here. So I'm still in gold because to me this still looks corrective. You had this move here, and then up, and then up. I think the move down is over. But again, if I get a close below this area, I'm gonna sell the position in gold. And let me just show you what those look like right now. Let's go over here to the monitor tab. Now, I messed up here, and apologize in advance. There's two accounts in this paper trading account. One is a margin account, and one is an IRA account. And I've been meaning to do this in the IRA account, but the other day I wasn't paying attention and entered those orders in the margin account. So right now I'm just going to select all accounts so we can see everything. This first one here is gold. So last Friday on April 24th, it triggered our long position and bought 6 contracts at 236, and right now we're slightly underwater with those at 211.15. So, and you can see that that's reflected here with this negative number right here in gold. This minus 147. Now you can see this one right here is our SPY position, and it was negative. This is where I sold puts, which is the same thing as buying stock. It's not the exact same thing, but it's similar to buying stock because I'm short puts. And that one we bought at 253. Now when that one goes down in value, we make money, right? So because we sold something. So we bought those at 253, and they're currently 233. So we currently have a 20-cent gain in there. Times 500 is $100, and that's what you see right here. This other trade is a strangle. I'm just kind of letting it sit there, but we're not going to worry about that one right now. So anyway, that's kind of what's going on with these trades, and I pretty much told you where I want to be out. Like if the SPY, I've got the SPY up right now. If the SPY closes below, we get a close below this level right here. And now, if it closes below this level, we're gonna have a loss of like, I don't know, $1,200 or something like that. So the size of the account is about $7,500. So, you never want to lose more than 2% of your account. $7,500 would be, I don't know, what would that be? 2% of 75, that'd be $1,500. So as long as we keep our losses below $1,500, we're probably okay there. But I think this trade looks good on the SPY, at least for now. Once we get up into that resistance area that I showed you on the S&P 500, and I missed the click there. Once we get into this area here, anything really, maybe even a tick above this high right here. In fact, I'll probably just go ahead and put an order in. If we get just a little bit above this high right here, probably go ahead and buy the SPY back, just so we don't get whipped around and actually end up losing money. So probably looking for a move above this area, and then I'll go ahead and get out of that position. All right, let's look. Let's go to NinjaTrader real quick and look at the ES. Let me put it on the right time frame. I'm going to put it on I guess we'll put it on the weekly. Or is it the daily? I think it's the daily. The daily is the one I showed last week that had a decision point on it. Well, the weekly does now too. So what this is basically saying, these decision points come up in areas after a pattern looks like a trend terminating pattern. So that's why this DP came up here. Now, it came up here too because this pattern back here looked like a trend terminating pattern. Of course, it sold off and then rallied back up. So the same thing could happen here. It could sell off and then rally back up. But these are usually pretty good trade entries, or you at least want to have a lot of caution if you see, something like this at the top of a trend for your 401k anyway. Let me look at the daily, because I think the daily is the one I actually wanted to look at, because the daily is the one where I had the resistance area up here, and I talked about it last week that we were in that, we had touched that resistance area, and sure enough we got a pullback. So these areas are mathematically on there. There's math behind the scenes. I'm putting these boxes on here, and they're pretty good. I mean, the market tends to move from pivot to pivot, and that's what these DPs do, is they mark potentially where the next pivot might be. So if we just mark that right now, for example, we mark one here, we're showing that pivot would be down here, and then if you mark one from this point here, this pivot, then that's saying the market could, its next move up, it could go into this area. So that's 21. Now, keep in mind this is futures, but that's 21.26, 21.30 area. Notice these moves are getting smaller and smaller. This is getting tighter and tighter. And this is, think of it like a spring coiling up, and then that energy will come out of that spring very rapidly. This is why really when you start getting into these rising wedges and stuff, they're usually trend terminating patterns, and you don't really want to, there's so much overlap and everything that it's not even worth really trying to get the last 1 or 2% out of the trend, because the corrective moves are so violent. And hopefully I don't want anybody to lose money, but hopefully we'll get to see that, and I'll be able to point that out to you so that you can see that it actually does happen. And it's not me just saying that and nothing's ever going to happen. Let's look at the DAX while we're in here. The DAX is finally, it made a really good run here, and finally it started to pull back. And I said last week, or a couple weeks ago maybe, that when you have an abrupt pullback like this one right here, that usually, just my experience, like here's an abrupt pullback, but see that it chopped a little bit and then made newer highs. But usually when you see this, it usually means there's going to be one more high. So I still see that, and so you could get something like that on the DAX. That's what I'm expecting to happen at this point. But it might not. This might have been here, let me zoom back in. This might right here have been the sharp pullback, right here to here. And then this was the one more move up. So this could be the beginning of a correction here. And at some point, I guess what you would do, the way I would go about trying to figure that out, is I would go to a daily chart, and then I would take a DP off this swing right here. And you can see that we're right there. But if we start trading below here, like, in this 11,204 area, then likely what's going to happen, normally what happens is once you've broken that prior pivot, if you notice, this is a 5-wave move. So let me do that real quick. Let me click here. You can see here it goes 1, 2, 3, 4, 5. So here's your 4th wave. Once you break that 4th wave, the rule is it generally goes back to the start of the pattern, which is right here. So, whoops, that didn't work. Sorry about that. So if we start trading below here, then the odds are we're going to come all the way back here to this 9,200 area. So if you're in the DAX, you need to be aware of that and be careful, okay? Because you're going to give back all these gains basically since December. I mean, the whole first part of the year and the latter part of last year. Let's look at gold. Gold, we've already talked about gold, but I think gold looks good here. To me, it looks like it wants to set up and go higher. Now, it was a little scary looking. You know, this is a pretty scary looking move. But sometimes this happens in these corrective patterns. So it could go back and it could come down here and actually make a lower low. But I really think gold is probably just about done selling, and it's probably going to lift higher from here. There may be a little bit more selling. You might get another candle that looks like this, but then we'll probably get a real small candle inside the body of that, and then maybe some sort of gap up and off to the races like that. So, and I would say that we probably don't even need to worry about gold. If it does this, we don't even need to worry about it until we get up into this 1320 area. That'll be the next area of resistance. So hopefully that'll pan out, and we'll get to make some money on that, and that'll be kind of interesting for the channel here. The euro, the euro finally quit going down. We've been pointing that out here for the last couple of weeks, and looks like it's wanting to make a pretty good move. Just to point out here, in Ninja Trader, you can see this gray band here. Steve Griffiths, he calls those the strength bands. And anytime you get volume outside those strength bands, it usually means this trend is not over. So it might have a brief pullback and then it continue higher from here. Maybe get up into that 1120 area before we see any kind of significant pullback in the euro. Now, having said that, the dollar looks like to me it's just about done. So it could be that the euro is just about done too. We'll just have to see. In fact, let's go back and look at the dollar. We didn't look at the dollar. Here's that. Well, you can't see it because it's off the screen. Here's the all-time high right here in the dollar, or the most recent high from 2002. And we've had this long drop in the dollar, and then a consolidation, and then we've broken out of that consolidation. And then, I've actually mentioned that I thought the dollar would pull back into this yellow box we were talking about up here, but then I said, well, this is still pretty corrective. It could be over, but I said that I really thought it would pull back into this yellow box area and then take off. So it looks like that's what that wants to do, and to me, from here, the dollar looks like it wants to make another low and go into this yellow box or real close to that yellow box. Another thing, there's a couple of things that I was reading that I thought were interesting in kind of the world economy, world market. One of them was, and we talked about the National Association of Credit Management or Credit Monitoring. We had a big spike down in credit acceptance from business. In other words, businesses going to the banks and trying to borrow money, and the banks denying them that credit. It was a spike. I showed it last week. There was a spike actually below the 2008 low when the banking system, quote unquote, froze up. So that probably doesn't portend any good news, and I wanted to reiterate that. The other thing is China is starting to falter a little bit, and of course their empty cities and empty housing over there has been on 60 Minutes. It's been on 2020. But I was reading this week that They estimate there's 70 million units over there that are empty. Now somebody had to borrow money. Well, I'm assuming somebody had to borrow money to build all that, and somebody's expecting it to make money. Well, obviously, if no one's living in it, it can't make money. So there's clearly something going on in China with this real estate, and as stresses start to build up into the financial system, those Warren Buffett used to say, we'll get to see who's been swimming naked. And what he meant by that is, people that are taking too much risk, getting too far out on the debt curve, and then, basically forced into bankruptcy or default. So that's one thing that I saw this week. The bond market, again, to me looks very ominous at this point. The interest rate market. Let's put that back up there. You could have, this could take out pretty quick. Probably what's going to happen is it's going to get up to this line and then pull back a little bit. But if you're still holding bonds, you really gotta ask yourself, unless you think the U.S. is actually going to have negative rates like they have in Europe, and I don't know. Would you keep your money in the bank if you had to pay to keep it there? In other words, let's say the bank charged you let's say they charged you 1% of your money to keep your money in the bank. 2%, 3%, whatever the number. This negative interest rate thing I don't think is very sustainable. And bottom line is we're at 35-year lows in interest rates, and the cycles run 35 years from swing high to swing low, 35 up, 35 down. So I think there's a lot of evidence in the macroeconomy for interest rates going up, regardless of what the Fed does. So just so you know, you could get up to this old high right here. We could get up to this old high and then actually pull back a little bit. That's what the market does. It pulls back. You get something like this. Okay? And then, boom, take out right over that descending trend line and off to the races. So again, I'm going to say, if you're in bonds, if you're in bond funds in your 401k or IRA, be very, 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 very careful. You're going to lose lots of money. Just a 1% move in interest rates in a bond fund could cause you to lose 10% in your principal in your bond fund. So be very, very, very careful. And with that, I will close this week's Middle Class Investor. And until next week, we'll see you guys later. Have a good one, everybody. Bye-bye.